In the final days of a great financial bubble, everything feels perfect. The gains seem effortless. The media celebrates newfound geniuses. Anyone who expresses doubt is called a fool, a doomer, or someone who just doesn't get it. It feels like a new era has begun, a new paradigm where the old rules of value and risk no longer apply. It feels like prosperity is permanent. This feeling is not a feature of success. It is the single most reliable symptom of a fatal disease. Stock market crashes are not random sudden events. They are the inevitable mathematical conclusion to a party that has gone on for too long. They are a fever breaking. And just like a disease, they show clear symptoms long before the patient collapses. The problem is, in the midst of the party, everyone is incentivized to ignore the symptoms. The bankers, the media, the government, and the public are all making too much money to admit that the foundation is rotten. History, however, is not drunk. History is sober. And when you look back at the biggest crashes of the last 100 years, 1929, 2000, and 2008, the exact same warning signs appear, in the exact same order. Today, we are deconstructing that blueprint. We will show you the warning signs that appeared before every major collapse. And then, we will hold that blueprint up to our current market in 2024 and 2025. What you will see is terrifying, because every single warning light is flashing red right now. Our first case study is the mother of all crashes, the 1929 Great Crash. The 1920s were a party. The Roaring Twenties were a time of new, world-changing technology. The automobile, the radio, and the airplane were making the world smaller and faster. There was a sense of unlimited optimism. Everyone believed they were in a new era of permanent prosperity. This optimism spilled into the stock market, and the first warning sign appeared. Warning sign 1. Insane valuations. This is the most basic sign. It's when the price of an asset becomes completely disconnected from the profit it actually makes. We measure this with something called the price-to-earnings ratio, or PE ratio. It's simple. If a company earns $1 per share and its stock price is $15, it has a PE ratio of 15. For most of history, a PE of 15 is considered a fair, healthy valuation. In 1929, at the peak of the bubble, the stock market S/PE ratio hit 30. This was led by the new technology stocks of the day, like RCA, Radio Corporation of America. Because it controlled the new magic of radio, its stock soared over 500% in a single year, despite its profits being tiny. People weren't buying a company, they were buying a dream of the future, and they were paying a price that had no basis in reality. This means that investors were so optimistic, so drunk on the party, they were willing to pay $30 for every $1 of profit. They were paying double the historical average for the same assets. They were pricing in decades of perfect, uninterrupted growth that was never going to happen. The foundation was already cracked, but no one wanted to look. Warning sign 2. The money supply disconnects from the real economy. This is the fuel for the fire. Bubbles cannot happen without cheap, easy money. In the 1920s, the Federal Reserve, America's central bank, made it very easy to get money. They kept interest rates low, which encourages people and businesses to borrow. The result? The total amount of money in the economy, the money supply, nearly tripled during the decade. But the real economy, the actual production of goods and services, only grew by about 10%. This is a classic sign of an economy becoming unhinged. The financial economy, the world of paper assets, was growing 30 times faster than the real economy of people making and selling actual things. Think about that. You have 3 times as much money chasing roughly the same amount of stuff. Where did all that new printed money go? It didn't go into building new factories. It went straight into financial speculation. It went into the stock market, pushing those 15x valuations up to 30x. The bubble was being inflated by the central bank itself. Warning sign 3, mass public speculation using debt. This is the accelerator. This is what turns a fire into an inferno. In the 1920s, for the first time, regular people were told that the stock market was a one-way bet. Stories of shoeshine boys and waitresses getting rich from stock tips were everywhere, and they did it using a toxic tool, margin debt. Margin debt is a simple and deadly concept. It means borrowing money from your broker to buy stocks. You put down $10 and the broker lends you $90. You're now controlling $100 of stock with only $10 of your own. It's a wonderful trick on the way up. If the stock goes up 10%, your $100 becomes $110. You pay back the $90 you borrowed, and you're left with $20. You just doubled your money. But it is a death sentence on the way down. If the stock goes down 10%, your $100 is now worth $90. The broker still wants his $90 back. You are left with zero. Your entire investment is wiped out. Worse, if the stock drops 11%, you not only lose all your money, you now owe the broker money. This is called a margin call. And it's not a polite request, it's an automated execution. And when margin calls happen, the broker doesn't ask you for the money, they just force sell all your stocks to get their money back. In 1929, margin debt hit record highs. The entire public was leveraged to the breaking point. When the market finally turned, the first margin calls went out. This triggered a wave of forced selling, which pushed prices lower, which triggered more margin calls. It was a domino effect that could not be stopped. The crash wasn't just people panicking. It was a mathematical forced liquidation of an entire system built on debt. This is the mechanical, unstoppable nature of a debt-fueled crash. The system was no longer driven by human emotion. It was being driven by an algorithm of liquidation. Now let's jump 70 years into the future. The 2000 dot-com crash. The technology was different, but the psychology was identical. The new era of the 1920s was replaced by the new economy of the 1990s. The new technology was the internet, and this time, the public was told that the old rules really didn't apply. This time was truly different. Warning sign 4, the new paradigm. Lie. This is the story everyone tells themselves to justify the madness. In the 2000s, the story was that the internet was so revolutionary, traditional metrics like profit and revenue were outdated. They were for old-fashioned brick-and-mortar companies. The new metrics were eyeballs, or page views, and user acquisition. The goal was not to make money, but to grow as fast as possible. This belief system allowed for the most insane valuations in human history. This narrative was pushed 24/7 by a new financial media, who paraded new 25-year-old geniuses on television every night. Analysts who worked for the big banks, whose job was to sell these worthless stocks to the public, would put strong buy ratings on companies they knew, in private, were complete garbage. The entire system was set up to pump the bubble higher. Warning sign 5, impossible valuations, the 1929 echo. The PE ratio of 30x in 1929 looked logical compared to 2000. Tech stocks, especially in the NASDAQ index, were trading at an average of 200 times earnings. Let me say that again. People were paying $200 for $1 of profit. But even that number is a lie because it only includes the companies that had earnings. The real madness was in the companies that had zero revenue. Companies with no product, no customers, and no profits were going public and being valued at billions of dollars just because they had a com in their name. The most famous example was pets.com. It was a company that sold pet supplies online. It was also a company that was losing money on every single sale. They were buying dog food for $10 and selling it for $3 just to acquire users. They spent millions on a Super Bowl ad with a sock puppet. The market valued this money-burning furnace at hundreds of millions of dollars. It went bankrupt less than a year after its Super Bowl ad. This was not an exception. It was the rule. Another famous example was Webvan. It was a company that promised to deliver groceries to your door. It raised $800 million, built massive, complex warehouses, and promised it would change the world. It, too, was valued in the billions. It also went bankrupt, having burned through all its cash, proving that a good idea is not the same thing as a good business. This was not investing. It was a collective hallucination. Warning sign 6, record margin debt, the 1929 echo. And how did people pay for these worthless stocks? The exact same way they did in 1929, margin debt. By March of 2000, margin debt had maxed out, hitting an all-time high. Everyone was all in. Everyone was borrowing, convinced that these new economy stocks could never go down. And then, just like 1929, the market turned. The first margin calls went out, and the same forced selling domino effect began. The NASDAQ index, which was the home of this bubble, collapsed by nearly 80%. Trillions of dollars in paper wealth vanished. The new economy was a lie. It was the same old bubble, just with a new buzzword. Now, our third and most recent case, the 2008 housing crash. The system had learned its lesson, or so we were told. The bubble didn't reinflate in stocks. It moved into something safe as houses. Warning sign 7, asset prices. Disconnect from reality, the 1929 echo. This time, the asset wasn't a stock. It was the family home. For decades, the historical rule of thumb was that a house should cost about 3 times a person's annual income. By 2007, in bubble cities like Los Angeles, Miami, and Phoenix, the average home cost 20 times the average annual salary. This was mathematically insane. It was justified by a new lie, the lie of the housing ladder. The public was told that you had to buy a house at any price, or you would be priced out forever. The plan wasn't to pay the mortgage with your salary. The plan was to sell the house in a year to the next person for an even crazier price. Warning sign 8, mass market speculation, the 1929 echo. In 1929, the system used margin debt to pull in the last buyer. In 2008, it used something even more toxic, the subprime mortgage. A subprime mortgage is a loan given to someone who has no ability to pay it back. Banks created loans called ninja loans. It stood for no income, no job, or assets. Think about that. Why on earth would a bank do this? Because the system had changed. This was the dark innovation of the 2008 bubble. It was called originate to distribute. In the old days, a bank gave you a loan and held it on its books for 30 years, so they cared if you paid it back. In the new system, the bank gave the ninja loan, collected a huge fee, and then immediately sold the loan to Wall Street. The banking system was creating money and lending it to people who had no income and no job, so they could buy houses at 20 times the average salary. The original bank had zero risk. They made their money up front and passed the ticking time bomb to someone else. Why would they do this? Because they needed more buyers to keep the prices going up. The entire system had become a Ponzi scheme. By 2007, these toxic subprime mortgages made up more than 10% of the entire market. It was a time bomb waiting to explode. Warning sign 9, hiding the risk, the 2000 echo. The banks knew these loans were garbage, so they innovated. This was the new paradigm, not lie, of 2008. They took thousands of these toxic subprime mortgages and bundled them together into a new product called a derivative. A derivative is just a bet on the value of something else. In this case, it was a mortgage-backed security, or CDO. The banks bundled this toxic waste, paid a rating agency to stamp it AAA, the safest rating possible, and then sold these safe investments to pension funds and retirees all over the world. Who bought this? Your local government, your state's retirement fund for teachers and firefighters, European banks. All of them were desperate for a safe investment that paid a slightly higher interest rate. And they trusted the Codes stamp from the rating agencies like Moody's and Standard & Poor's. But the rating agencies were paid by the very banks that created the toxic product. It was a closed loop of fraud. It was the greatest fraud in financial history. It was a system for hiding risk, but you can't make a pile of garbage safe by wrapping it in a bow and calling it derelict. When the ninja borrowers, who never had any money, predictably stopped paying their mortgages, all of these safe investments went to zero all at the same time. The entire global banking system, which we now know is built on trust, froze, and the world plunged into the great financial crisis. So here's the blueprint for every crash. Insane valuations. Easy money from a central bank, massive public borrowing and debt. A new paradigm story to justify the madness. A complex new way to hide the risk. Now, let's look at today, 2024 and 2025. Warning sign 1, insane valuations. The historical average P/E ratio for the stock market is 15. The peak of the 1929 bubble was 30. As of 2024, the market's P/E ratio is 28. We are paying nearly double the historical price for every dollar of profit, a level second only to the dot-com bubble. Warning sign 2, easy money. From 2020 to 2021, the Federal Reserve printed more money than at any other time in its history. The M2 money supply exploded, increasing by over 40% in 2 years. Just like in 1929, that money had to go somewhere. It didn't go into building new factories. It went into stocks and real estate, blowing the biggest everything bubble in history. Warning sign 3, record margin debt. Just like 1929 and 2000, everyone is borrowing to gamble. Margin debt has hit all-time highs. The public is once again leveraged to the breaking point, betting that stocks can only go up. Warning sign 4, the new paradigm. Lie. What is the story this time? It's not the new era of the 1920s. It's not the new economy of 2000. This time, the magic word is AI, and the valuations are an exact echo of 2000. Companies with AI in their name are seeing their values explode to 200x earnings or more, even if they have no clear path to profitability. We are seeing companies with no product and no revenue add billions to their value simply by announcing an AI strategy. The market is rewarding press releases, not profits. It is the exact same behavior as 1999. Warning sign 5, the trigger. In every bubble, the easy money from the central bank creates the party. The crash begins when the central bank, terrified of the inflation it created, pulls the plug by raising interest rates. This is what happened in 1929. And it is exactly what has happened over the last 18 months. The Federal Reserve has raised interest rates at the fastest pace in history to fight inflation. This is the trigger. It's the margin call for the entire system. It makes the cost of borrowing for corporations and homeowners unbearable. It exposes all the companies that were only surviving because money was free. It's the event that separates the real economy from the paper one. Historically, there is a lag. The market doesn't crash the day of the first rate hike. It typically takes 12 to 18 months for the pain to set in. We are now in that window. The patterns are not just rhyming, they are identical. We have 1929's valuations fueled by 2020's money printing, creating a 2000-style tech bubble all built on record-high debt. And the Federal Reserve has already pulled the trigger. History shows us that financial systems do not just bend, they break. And they always break when the same set of conditions are met. Every one of those conditions is present right now. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.